ladies and gentlemen, we continue in our efforts to provide quality voices, sensible people, professionals who've navigated bull and bear markets to combat this volatile situation in the market where every asset class except for equity is working. Joining us on the show is Mr. Jyotivardhan Jaipuria, founder and MD at Valentis Advisors. This is a very, very well-known PMS firm, and over the last 3 decades, Mr. Jaipuria has navigated all sorts of markets on Dalal Street. Let's see what 2026 holds according to him. Namaste, Mr. Jayavardhan, and a very warm welcome. Let's look at the markets from the point of view of the budget. Firstly, any expectations that you have, and how do you see 2026 from now on?
So, on the budget, like my general view has been that budgets have become less of a event than they used to. Because, as we know, a lot of the GST is outside the budget. So all those big tax cuts which used to happen are all outside the budget. There's some changes in custom duty, but, now with so many reductions in custom duty already, it's all very marginal. So ultimately it comes down to direct taxation, where also I think there's, a set part. So, there's not too much of changes which can happen. So I would look at budget more from a very macro point of view, that there is a slowdown in the economy. The government did a lot of heavy lifting after the, COVID in terms of spending on capital expenditure. I think they have indicated that they are done with their bit and they want private sector to take over. But even then, I would think, if the government can find some room, they should try and, increase the capital expenditure from the 10-11% which they are probably targeting. And probably the room will come if they can, go and sell some of the public sector shares which they have in the secondary market. Because, if they can do, let's say, 1 lakh crores of sale of some or any of the shares, you do a bit of some of the large companies they own, you can raise 1 lakh crores and, invest that in capital expenditure. Because economy is at a stage where you probably need a thrust both from the government and from the private sector to keep the growth momentum moving. So that is what I would be looking for. At least the tone from the government doesn't sound like they're doing this, but this is what my wish list would be actually from the budget.
Mr. Jaipuria, good afternoon to you, Sakshi this side. I want to ask you, can this budget in any way turn the corner for what's happening in the markets? The last entire year, the government definitely focused on every which way possible to bring a lot of tax reliefs on direct, indirect taxes, reforming the direct tax code as well. But despite all of that, the markets have barely moved a needle. How would you look at this budget as an opportunity for the government to, bring back investors' sentiments positive on the stock markets?
Yes, actually, so there are two things which, market wants. So one is, they want the direct thing. I want capital gains to be cut it for equity. Now, because, foreigners have been selling so much, it is, cut it for the foreigners at least. Where, there's some actually logic to do it. Because India is probably one of the few or maybe the only country where FPIs pay capital gains tax. Most other countries, FPIs do not pay capital gains tax. So at least for the FPI, there's a logic that you want to cut it for them. And I don't think they'll do it for the locals because, they just increase the capital gains tax. So, if they keep increasing and cutting every time, then it will be somebody will say you're not able to come with a stable taxation. So, one is what people would want direct. And maybe here, what they could think of doing is if they can do on the FPI, they can remove the taxation. Though their view has been that we don't want differential taxation for the foreigner and Indian. And the other thing is what they do to provide a thrust on the economy and ultimately what comes down to earnings. So for me, the wish list would be you do capital expenditure so that the economy gets a thrust. Because ultimately, one reason why markets didn't do well whole of last year was the earnings never grew. So the last 6 quarters earnings have been in single digit, and ultimately, markets are slave of earnings. So if you have a single digit earnings growth, then market tends to reflect that.
Okay, Mr. Jaipuria, this particular market that we see now, in which there is a secular rally only in one sector, metals, somehow reminds me of the dot-com bubble in 1999-2001 when only tech was rising. Are we in this kind of a situation when it comes to a single sector sucking away money away from blue chips, away from growth companies, and then causing the bubble to burst. What is your opinion on this one?
So, we've seen metals rally, but then they've come off a long period where they did not do well. So we are nowhere close to, the tech bubble phase. Like, if you see at that time, tech had probably become like 35-40% of the market cap or of the indices. And, same way, if you look at US today, you take the Magnificent Seven, they are very large proportion of, the indices, as well as, all the returns have come from there. So metals, we are probably just at a start, and we are not at a stage where they have done so well that they occupied a very large part of the market. At the same time, of course, these stocks have done very, very well, and as we know, metal stocks tend to be very volatile. Metal commodities even more volatile, and the stocks also tend to be volatile. So if you get the cycle right, or if at some point the cycle turns, then the downturns in the stock price are very, very sharp. So that's what one needs to remember. But at the moment, I would not say it's become like a total bubble where there's been so much euphoria and the stocks have become such a large part of market cap or anybody's portfolio. Also, I don't think metal is such a large component of their portfolio.
Right. Mr. Jaipuria, since you're saying that the capex outlay should increase, which are the core sectors that will benefit from this capital expenditure that may go up by 10 to 15% as is the broad expectation this time too?
Yeah, so Sakshi, 10% is just, it's basically in line with nominal GDP growth. So which is what I think they will do. My wish list is that they do much higher than that and we get to like a 20% so that we kickstart the economy. So some part of it is going to go to defense, because I think defense will get a bigger share than they've got, given the developments over the last 1 year in terms of the Operation Sindoor. But apart from that, railways is one thing they've focused on, where I think there'll be lower capex spend, but they'll be much more selective and probably stuff like Kavach. The other big area they used to do was the highways, which I think is probably taking a bit of backseat in terms of growth. So I don't think we'll have a huge growth coming there, but there'll be a lot of thrust in some other areas, right from public infrastructure would be a key thrust over there. So this includes like the Jal Jeevan Mission, where things have not been spent for the last 2 years, and buildings of roads and building of infrastructure within the cities in terms of sanitation and all. So I think those will take a much bigger thrust from them. The other focus they have is on renewable energy. So, we've had this Kusum project, which was there for the solar pumps, which, saw a great thrust last year. So I think they'll continue with it. I don't think there'll be huge jump in the allocation there. But some of these schemes which have been successful will probably be continued in the budget.
Okay. Mr. Jaipuria, how is your own portfolio, the two that you have at Valentis, faring over the last 6 months? What we have seen actually is that while the indices may not have slumped much, but individual mid-cap and small-cap portfolios have been really in deep pain. How have you navigated the last 6 months? How do the next 3 to next 6 look for Valentis unit holders?
So, the last 6 months were better actually, but the last 1 year is where it's been horrible. So if you look at the calendar year 25, the differential between the large cap and the small cap indices was 16%. So the small cap indices did 16% lower than what the large cap indices did, because the small caps fell quite a bit, and the large caps were positive. A lot of the pain happened in January, February of last year. So if you see, the whole breakup, Jan-Feb itself, the indices were down over 20%. Since then, the last 6 months have been relatively better. You got positive return both in the small cap as well as in the large cap, and more or less it's been very, very similar. Now, apart from the indices, if you think of the broader market, actually the pain has been even more than what the small cap index pain shows, because a third of the stocks on the exchange are down more than 40% since their all-time high. So it's been quite a brutal sell-off which we've seen in a lot of the stocks. We've tried to navigate it, and we've also been more or less in line with what the small cap indices have done. We got a negative return last year overall, if you see, but last 6 months have been positive because last 6 months the small cap has done well, we've done well, and even the large cap has done well. Going forward, I'm more optimistic. So if you look at our Jan 25 outlook a year ago, we were very clear that the small cap will not do as well as the large cap, and our view was small cap will be probably flattish to slightly negative return. We think this year will be better for the broader markets. So we think that the small mid cap will probably even outperform the large cap over the course of the year. It may be a little back ended, but it will be a better year for broader markets than what 2025 was.
Say, for instance, for all those retail investors who've been holding on to mid and small caps with huge losses, should they now stick with it since now you believe there will be a turnaround there? Should they make any further rejigs if some people had heavy large cap exposure, should they switch to mid and small caps as well? How would you advise them?
If somebody's held the small caps through all the pain of the last 15, 18 months, I think it is too late to sell because, we may still see pain over the next quarter. But, when the turn comes, a lot of these, the turns are also quite sharp and, vigorous. So, the way I look at it is this is the year where earnings will change. Like I said, for 6 quarters, we've had a single digit earning growth. I think, calendar 25 will see a double digit earning growth coming through. We'll probably end, FY27 at like a 12-13% earnings growth. And the small cap and mid cap will lead the earnings growth. So we are looking at a 20% earnings growth coming in the small cap indices and around 16% in the mid cap. So that's the reason we are positive on the small and mid cap. Second, of course, is there's been a lot of pain already. So, there's no euphoria now, everybody's negative on it. And third is the performance has been quite poor in the last 18 months. So this is the reason we are looking at, owning it. For people who already held it through the pain, we would advise not to sell it now. You may see still some pain over the next few months, but not get carried away. If you want to do a shuffle or you want to put in additional money, my thought would be do it in a staggered manner over the next few months. Because there are a lot of global events which would come and disrupt the market. So, instead of doing it in one shot, I would say stagger it over the next few months and do it.
I think this is very sage and practical advice, Mr. Jaipuria, that you've shared, and this is music to the ears of many, many investors who've, for the last 24 months, last 18 months have been in pain. And as you very rightly say, sentiment is down in the dumps, there is no euphoria. So no point selling now. In fact, this could be the turnaround time. It's always darkest before the dawn, and let's hope dawn breaks soon. Mr. Jaipuria, for our viewers, could you please put in context this parabolic rise in silver in particular, and where do you think it is headed?
Okay, so I'm not the expert on silver, and it's not like I own a lot of silver. I own a lot of, so just very macro, why these metals, or let's say why the precious metals are going up, is the de-dollarization trade. That generally people are losing faith in the dollar. There's no great alternate currency which is there with people that instead of dollar, I'll do this. So what you have is dollars. All the central banks want to reduce the dollar they have as part of their central reserves. And so gold has become one element there where people have been buying it. Now, silver is treated as a precious metal. So at some point when gold went up, silver was not going up. The whole thing was silver has not kept pace with gold and it's going up. Silver, unlike gold, is also got an industrial use. So, as the frenzy picked up, it was like, okay, there's a lot of uses of silver which will gain because data centers will come up. And, it's not just silver. After that, it's gone to copper also. Because there is a use case for that, which is in data centers and all more and more metals will be used. But at some point, there's also a frenzy which builds in and there's a fear of missing out which builds in. So, what we are seeing now is a large frenzy. And to me, it was like, I wouldn't buy at these levels.
You won't buy at these levels, but what would you tell everybody who's facing a FOMO that every day they look at and wake up and they see 25,000 rupees additional on silver and then they feel kali le liya hota to behtar tha, aaj kuch to paise ban jate. Every day they are feeling the same thing. How are you telling,
Yeah,
what are
so
you
it
telling
is,
those
so,
people?
like I would have told you the same thing 20 days back and you would have been totally wrong, right? Like, okay, it's gone up so much and what nonsense are you talking? But with a lot of these seats very rare for the asset class to go up like this and not have a decent correction. So it is like, if you are like such a great trader and you're flipping and you're able to flip very quickly, but otherwise it would be like wait for a decent correction to come at least before you get into this. But yeah, there's a FOMO every day. You could have made money by buying it yesterday and selling today.
Actually, Mr. Jaipuria, this is very well said. I think in hindsight, everything looks perfect. You could have taken a trade or a delivery at X percentage points and then ridden it all the way up to 20,000 rupees a day. But yes, would you, given the rally that has happened, would you tweak the allocation of precious metals in multi-cap portfolios at this point of time?
Yeah, so see, we do pure equity, so we can't like have anything else in it. So we only do equity. And so for us, there's no great, unfortunately, we don't own gold and silver in the portfolios. If we were, then maybe we would have tempted to come off a bit.
Okay, let's come back to the equity part itself. Mr. Jaipuria, we have underperformed the globe widely over the last 1.5 years for sure. FIIs also have been, chasing better opportunities. Tell me, how much of the global capital is taking a fleet from India only because of India-specific problems, and how much of it is like chasing better opportunities, and how do you see things panning out now?
So Sakshi, this is a mix of both, right? Ultimately, you go wherever things look interesting. So two, three things helped that change. So one was if we go back to history, September 24 was when the Indian market peaked and when the Chinese market bottomed out. And the trigger for that was stimulus which was done by China. So, after that, China kept going up and India kept going down. Before that, China used to be called uninvestable, that we just don't want to invest in China. Everybody was just trying to run away from China. There was a lot of selling which China saw over the previous 12 months. So, global capital turns and it can turn very, very quickly. Now, one reason we've probably had like an India specific factor is we just not had earnings growth. So you were sitting on a 20p at a time when, at that time global markets were, or the emerging markets were at 10p. India was like effectively double the P of emerging markets in September 24th, and valuations were very high. And then you had 6 quarters of earnings growth, which were very, very low single digit. So effectively, highest valuation and one of the lowest earnings growth. And that was one India specific trigger, which basically meant that people kept selling. Now the other was probably what I would call non-India specific. The whole trend in the last 15-18 months has been the AI trade. And India, unfortunately, does not have AI stocks. So money has gone to Korea, it's gone to Taiwan, it's gone to China, it's gone to basically the AI trade. So what I'm hoping this year is India will do relatively better, because India is what I call the pen trade now. India is the most underweight market for everybody. FIs are underweight India by 2.75%, which is the highest underweight they've been. Second is India was the worst performing market last year. We underperformed MSCI by 28%, which is our worst performance to MSCI. The last time we had something like this was way back in 94 when the 93, I think the FI money was just starting to come in. So since FI has come in, we've never done this badly. And third is, of course, now valuations have become more reasonable on a relative basis, because India still trades at 20p, but emerging markets have gone up to like 13.5p. So now that 100% P premium has now shrunk to like 50-60, which has been the long-term average. So I think this year we'll probably have better or lesser FI flows. We'll probably get a little more positive, and I think we'll end the year doing relatively better than what we did last year. But one is at some point when the AI frenzy cools off, that is when India starts to get money, or India has to do something on its own, which could be like earnings growth start to come, maybe the Indo-US deal gets signed, maybe we have some measures from the government in the budget which helps this stop this outflow.
Right, and I hope every one of the thoughts that you've expressed, Mr. Jaipuria, works out in terms of how this swing trade should work in favor of Indian equities. Given the pain and given the way how we've underperformed over the last 7-8 months or so, are there any sectors that you are still not comfortable with in terms of valuations, where your research team is not looking out for any picks?
So see, we never say no to anything. So we always keep looking at everything. But if you ask me on a very macro basis, we like consumer. And on a micro basis, we struggle with the valuation on consumer. So, if we can find cheaper stocks, we'll be more overweight consumer than we are in the portfolio. But a lot of this, so, in particular, I would say the consumer staple is something we've been underweight, I think, forever, got like 5 years. And we continue to be underweighted, though we like consumer. We think, discretionary is a better way because there you have very high valuations and very, very slow growth. Hopefully, there'll be some turn there in the demand environment which will start helping them. But I would say we continue to be underweight that in a big way still.
All right. Mr. Jaipuria, one more thing that I wanted to ask you. If, you were to personally advise a finance minister ahead of the budget, what would you advise this time around that you think is the need of the hour?
So, like Sakshi, like I already said, I would think, more capex is required from the government. And obviously there's a shortage of money. So it's not like we have a lot of surplus money. And that needs to be funded by selling some equity and disinvestment. So, if I look back in the last 10 years, 11 years, when the BJP government came initially, there was big thrust on, we'll do privatization and disinvestment. But that never gathered steam for them. So I think, we missed that opportunity because we have lots of shares. 1 lakh crores is not a big amount to raise for the government. And if we can do that in, probably capital expenditure, that would be like a great thing. Of course, from the equity market, we always want, capital gain concessions to be coming. But, if there's one thing which you have to say, I think it's, get the economy moving because that's very critical for like the country as a whole.
On that very optimistic and very necessary note, Mr. Jaipuria, let's call it a day. Thank you so much for your time and, of course, for such practical and wonderful thoughts in terms of what small caps investors should do and how the market just might turn on its heel. We are very grateful and thank you so much. All the best for 2026.
Yeah, thanks a lot, Shail. Thanks, Sakshi. Bye.
Thank you, sir.
That, ladies and gentlemen, was Mr. Jyotivardhan Jaipuria, MD at Valentis Advisors, a very well-known PMS on Dalal Street. Thank you for watching. There is a lot more exciting things happening on the other side of the break. Please stay tuned.
Markets move today to what's setting the stage for tomorrow. From tariffs